The Footprint course, Unit 11, the Initiative Drive. This is challenge day 19 of 30. In the following slide, we're going to focus on the art of deliberate practice. Why practice is imperative to high performance and how you can practice as a trader. What we're going to talk about today is this idea of deliberate practice, and I'm going to go through what deliberate means, and then I'm going to give you a few ideas of how you can be more deliberate in your practice. So the first thing, the definition of deliberate is it's done conscientiously and intentionally. Okay, now just somewhere write down on a piece of paper, conscientiously and intentionally. And ask yourself as you go through the week, ask yourself when you look at something, when you observe the markets, when you're preparing for your day, when you're recording your trade setups, are you doing this conscientiously and intentionally with purpose? Now, I think what a lot of you are going to find is actually you don't do it. Okay, what you're going to find is that a lot of you do it more as, you feel like you have to just fix up your charts and, then put in a line or two here and then you feel like, well, I've done a bit of effort, I'm deserving of something. Now, the second thing to in terms of definition is to engage in long and careful consideration. Now, again, it brings you back to this idea. When a lot of people look at charts, they look at it in a sense of, well, the market came down, it hit this support, or it hit this moving average, or it hit this reference point, and then it bounced. But how many of you actually think about, firstly, what brought the market down to that point in the first place, and then what actually made it bounce? Now, a lot of you might think that prices going down reflect sellers selling. That's by definition, that is incorrect. Okay, prices can go down for a number of reasons. There could be hedging reasons, there could be spreading reasons, there could be long liquidation. There's a number of reasons why prices go down. So how many of you actually engage in long and careful consideration when viewing the markets? Now, the reason I want to talk about deliberate practice this week, and the reason I've shown you that video is, a lot of us, including myself, we admire, we admire the best golfers in the world and the best sportsmen in the world, and we admire the skill and talent that they have, and we look at them and we envy them, and we think, well, I wish I could be that person. Why am I not that person? Well, I'll tell you why you're not that person, because at the end of the day, you do not deliberately practice every single day to become that little bit better. All right? Don't forget, these professionals, we only see the tip of the iceberg. We only see the end outcome. We don't see the hours upon hours of pain and suffering and purposeful practice that goes into it. Now, the picture I've shown you is a very simple annotation of what professional golfers have to do. Now, if you look at this picture, you will find that sometimes a professional golfer has to stand over a 3 or a 4 or 5 foot putt for 2 hours. He has to hit the same putt 100 times over, whether he likes it or not. Why? Because this deliberate practice is what will differentiate him from the winner and everyone else when it comes to that pressure putt. That is why they practice these things, and that is why you need to be practicing them. So let's go over a few points. Firstly, it might be a bit cliche, but practice does make perfect. If you practice the same thing time and time again, right, when it comes to actually delivering, you're going to execute far more better. And you're not going to execute better simply because you've practiced. You're going to execute better because there's a lot more trust in what you're doing. All right? We deliberately practice because we want to develop real skill. All right? Trading the markets day in, day out is not about finding those levels, clicking, and then you make a bit of money and you move on, you come back the next day. That's not trading. All right? Trading is about developing key skill sets, whether that's learning to sort of manage prices, if that's becoming better at managing risk, if that's better at trading an array of markets, whether that's understanding the difference between algorithmic type trading or longer term swing trading. Every one of these is a skill in its own. And in order to develop those skills, you have to deliberately practice what is going to make you better at that skill. Right? We've already spoken about the tip of the iceberg. Don't forget, the end outcome is just the tip. You know, you can marvel at you know, some traders. You know, I can look at traders around me and think, oh wow, these guys, you know, they're making £100,000 a day, and wow, why am I not that person? Why can't I be as good as him? But in the day, I don't get to see what goes on, you know, behind the scenes. I don't know what sort of pressure and, you know, sort of things he does on the weekend. I don't know what sort of, you know, mental exercises this guy is spending hours every single day doing. Right? But he's doing something. And that's the important thing. He's deliberately practicing something that makes him that little bit better. Then shortcuts. Right? This is something that a lot of people are constantly looking for in this industry. Shortcuts. There is no such thing as a shortcut. I cannot teach any one of you to trade. No one can teach any one of you to trade. There is no book, there is no mentor, there is no program, no tool. There's nothing in this world that can give you a shortcut to trading success. Nothing. Alright? That's the first thing to understand. Only you, through deliberate practice, can develop the shortcuts over a long run. That's the important thing to understand. Then, trading isn't fun, guys, I promise you. Trading is absolutely horrible. Okay, it shouldn't be. I love this game to bits, but I absolutely hate it sometimes. Right? It shouldn't be fun. If it's fun, you're not doing the right thing. It's a boring job. It's a process like any job. We get to the end of the day, we're green, we're happy. Okay, because we followed the process, we deliberately did what we needed to do, and the end outcome was positive. Right? During the day, it's not fun. It's not fun sitting here for 2-3 hours, and you're bored out of your head waiting because the market's not giving you anything. Important to understand that. Then smart practice. Right? Golfers don't just go out onto a driving range and hit 1,000 balls. Right? They work on very specific skills. They work on very specific elements of their game. Are you working on specific sets of your trading game? If you want to be a professional trader, what makes you any different to anyone else that wants to be a professional trader? Then, tools. What are some of the tools you can use for deliberate practice? Well, yes, first and foremost, a mentor is one of them. You need someone to guide you. Right? You listening in on this Periscope today, guys, already you are taking a step in the right direction. Why? Well, because I've probably got more experience, or I'm ahead of most of you. In other words, I've been through some of the pitfalls that some of you are going to go through. So me guiding you, me giving you a little heads up as, oh, you know what, you're probably going to blow out at some point. Yeah? Me giving you a heads up, you're probably going to average a bad trade sometime and have to learn a very, very valuable lesson. Me giving you these heads ups is going to speed your, you know, your learning curve up, and that's what's important, and that's why you want a mentor. Then, active. Okay, you have to be active traders. If you're sitting and looking at these markets going, well, I took one trade today because, you know, I couldn't find any other setups, and, you know, then tomorrow I took 2 trades. That's not good enough, guys. You have to be constantly scouring the market for opportunity, for new opportunity. Not just those opportunities, those pin bars and those support and resistance lines that you learned in the textbook. Okay, newsflash. If it's in a textbook, everyone has got it. Alright, if it's in a book, or if there's, you know, this wonderful speaker that's giving you all these wonderful setups, well, newsflash. Everyone's got it. It's public information. You have to be active every single day, because when you're active, you will learn to develop and memorize and see new strategies. That's what will give you a real opportunity in the day. Smart analysis. Don't spend 3-4 hours scouring the markets. You're wasting your time. Right? Be smart in how you view the market. Don't have 7 different tools. Don't have 7 different, you know, indicators. You're just complicating a simple process. Stick to one. Keep it simple, keep it smart. Analyze the market with a very specific intent. That way you're going to get very specific outcomes. Then, replay functionality. How often, and I'm going to show you this in a minute, how many of you do you actually ever replay how you execute in the market? I bet you, I'll take a bet, maybe 5% of you, maybe 10%. Right? Every one of the professional traders that I sit around, every one of the traders that I associate, I know they go at the end of the day and they go and look how they executed their trades. They go and look at the physical entry into the market of how they executed, how they managed to clip, how they got out of the target, how they took stops. They look at these things because it's all about the inches. If you can be better at the little inches, they're going to end up becoming yards one day. And that's why we focus on it. Then teams. There is nothing better than being part of a community, being part of a team, being part of people and associating with people that have a like-minded mindset. Take, for example, many of you have been to the gym before. Now, anyone knows that if you go to the gym on your own, yes, you'll be motivated for a few weeks. Yes, you'll push yourself for a few weeks. What about those hard days? What about when it's cold outside? What about when you're stiff? What about when you just had a long day and you can't be asked? Right? You need that person. You need that team to lean on. You need that other person that's saying, well, you know what, if you're not going to go, I'm going to go. And that motivates you, that pushes you. And that's what a team environment is. When you're in a team, if you can see people around you doing well, there is zero excuse for you to do badly. There is no reason for you to perform badly. You've got the same access to the same information, the same charts, the same everything. There's no reason for you to perform poorly. That's why you want to be in a team environment. So, to sum it up, guys, do you deliberately practice? Answer this question. Tonight, do yourself a favor. Be honest with yourself. Take a few moments tonight to just answer this. Do you deliberately practice what you're trading? If you're not being professional enough. So the initiative drive, again, one of the better momentum-based strategies. It's a great strategy simply because it provides very, very unique, easy clues and really good potential profitability. That being said, obviously, do note this is a Footprint standalone. As some of you might know or remember, we did talk a lot about initiative in the volume profiling course that Axia offers. So now you're going to see it being applied with the use of the Footprint tool. So with that in mind, obviously, in terms of execution, again, it is a little bit of a passive type execution strategy. Those are the elements of this trade strategy that you can expect to see. Let's now then move on and have a look at some of the principles to be adopted in the initiative strategy. So obviously, like every strategy, we're going to go through a number of different principles. Some of the key highlighted principles within the initiative drive strategy will include, first and foremost, initiative responsive price action, as we can see in number 10. And this will sort of really bring into full view the understanding of what initiative drive is, how it works, how it functions. Obviously, we'll always speak a lot about context because an initiative drive will ultimately do different things depending on the context. And the other two key principles we will focus on are delta pocket positioning as well as liquidity. Good luck with the session. Obviously, do bear in mind, once you're done with the session, you can come back on the slides and view all the charts as well as the examples, or the full examples, utilized within this unit.
So, patience is not how long you can wait, but what you do whilst waiting. Now, that's particularly relevant when it comes to the initiative drive trade strategy. The reason being is that the tip for this trade strategy is don't rush in. Okay, the market will reward early observation but patient execution. Okay, so very fitting. Now, before we move on to that, let's just talk a little bit about this idea of practice. Okay, now you watched that video all about practice and gave you some good ideas about practice and what practice is, but I think it's nicely summarized by Gary Player, where he said that the harder you practice, the luckier you get. Now I want to tell you why practice is so pivotal. Okay, what most people don't realize is that through practice you're going to develop edge. Why? Let's take for example what I've had you doing for the last couple of units, where you watch a video, we complete the template together, you watch a drill and you complete the template on your own. Now that is a form of practice. Now you've got to say, well, how are you developing edge by completing that form every day? Well, it's simple. Let's say that over a series of 10 examples, you found that in the one strategy, volume is always high when there's a favorable outcome and always low when there's a poor outcome. Guess what you've just developed? Okay, through practice, you've developed edge. Now that's the purpose of practice. It's about developing loads of little edges. Okay, constantly developing edge, whether that's based on volume, time, you know, the market you're trading, the volatility, whatever it may be. Through observing this day in, day out, through practicing in this manner, you're developing little edges. Okay, ultimately all those little edges together add up to an edge. Now, the template I've provided you with is your practice session. Okay, it's a very, very specifically guided practice session. Right, I'm putting the ball down and I'm telling you, kick free kicks for me now and for the next 45 minutes, and that's all you're doing. And you're kicking free kicks for the next however many days it takes. That's the purpose of not just the templates, but that's the purpose of practice, is to get you proficient at kicking free kicks. Okay, just one thing to notice with practice, and I cannot stress this enough. It must be smart. It must be consistent. Okay, the reason I share these two particularly with you is because I've made these mistakes for a number of years in my trading. Okay, I've very rarely been consistent. When I have been consistent, I've seen extremely good results. When I've been smart about my practice, i.e. following a templated approach, again, I've seen tremendously good results. So be smart. You don't have to practice for 3 hours a day. You have to practice smartly. Okay? And you have to do it every day and be consistent. Alright, now, the strategy we're going to focus on is the initiative drive. I've spoken about this for quite a bit now over the last couple of slides. Initiative, as we've said, it is exactly what the word said. It initiates. So someone steps in and we initiate in the market. Now this initiation, okay, will look like trend. So the usual characteristics will be there. We'll have high volume, high delta, high volatility, and ultimately imbalances. Okay, imbalances, low volume areas, etc., etc. Now the most important thing to understand about an initiative drive is the principle behind why an initiative drive occurs. To focus on that, let's go back one step and let's talk a little bit about the context where you can expect to see initiative drives. The first is the open drive. Now, for those of you who've taken the volume profile course I created, this will be no secret, this trade strategy to you. You'll know the strategy very well. The profile does show in a very, very specific way what an open drive looks like. However, an open drive is just simply a time-based initiation, i.e. the cash open. Okay, now this can be the cash open of any markets. In the European equity indices, we're looking at 8 AM. In the oil market, we're looking at 1:30 PM when the pits open in Chicago. In terms of the currencies, we're also looking at 8 AM. And in terms of the US bonds, around 1:20. So it all depends on the cash open. Now the first type of initiative you get is on the open drive. Now that initiative will look slightly different and have a slightly different nuance to the initiative drive taken in the middle of the session. So that's the second one. It'll be midpoint to the session. Okay, so that could be any time. That could be a couple of minutes after the open, a couple of minutes towards the close. Now, they're both going to show very similar characteristics. The main distinct difference, okay, is the initiative will obviously go from the beginning of the cash open, whereas obviously the second one will happen at a slightly different time. But the one that occurs at the cash open, initially, we do tend to see quite a lot of imbalances. Why? Because what happens in this example? Okay, we're going to use Goldman Sachs as the example because they rule the world. So Goldman Sachs has prepped the night before. They want to sell 25,000 contracts, or they want to buy 25,000 contracts at the market at the open of the European session, and they're going to do it as soon as the liquidity is being provided, i.e. cash open means that liquidity is available. Okay, why? Because all the banks are now officially trading. Okay, so Goldman Sachs makes the decision, they can execute on the open. Now what tends to happen is that a lot of the time it's not just Goldman Sachs wanting to execute this. Okay, and that's probably why we tend to get the initial imbalance. In other words, we get the spike up, the initiative, imbalance created, the market eventually finds liquidity. Okay, so remember, an initiative drive is simply about initiative. It needs to run into responsive selling. Okay, this responsive selling is nothing more than sellers providing liquidity to the market. Now, once it finds that responsive selling, bear in mind, okay, Goldman Sachs has a large order to execute, and this is one of the key differences. An open drive that occurs at the cash open has a very, very high probability of continuation. A initiative drive that occurs midpoint in the session has a far lower probability of continuation, and that's one of the key differences to identify between the two. Now, the reason is very simple. Okay, initially, Goldman Sachs is looking for liquidity. Okay, they will find some liquidity, but once those sellers have stopped responding to higher prices, okay, and the market's backed off a little bit, Goldman Sachs will then need to initiate again. Now, the reason we get a much higher probability of extension in the initial period is that it's far more obvious when there's an open drive at the beginning of the cash session versus middle of the session. Okay. In other words, in the middle of the session, there's been a lot going on. There's a lot more of an established range in the market. There's a lot more strategies being employed in the market. So by that very nature, there's much higher volume and liquidity potential. Okay. So that's the major differences between the two. Now, important is in terms of some of the principles to focus on, and I'm just going to maybe make a little bit of space here. So the most important thing is initiative. Okay, we might get the imbalance or not, but what I would say, if I was to compare the two, okay, if these are both drive higher imbalances, right? The first one will likely see imbalances because it's at the beginning of the session. Okay, the second one less likely, okay, to see an imbalance. Like I said, obviously there is liquidity being provided and a lot more strategies. So let's call this 8 a.m. open, and obviously let's call this 11 a.m. open. Okay, so you can see how context and time can play a very pivotal role in the type of initiative trade you're going to get. Now, what that means in terms of obviously the trade opportunity is very little, okay, because in both examples we're going to get initiative until we find responsive and responsive. The market will then back off and back off. Now, in the case of the first example, we know there's a high probability of extension. So what we're looking for is we're looking for absorption. Once we find that absorption, we're looking to be long. Now, remember what I said, okay? Goldman Sachs has got 25,000 contracts. That sort of a size order, because they are executing at the beginning of the session, they obviously require quite a lot of liquidity. By that nature, we're going to extend, or there's a high probability we're going to extend, but also they're probably going to extend quite aggressively. So what we'll see is the market will drive. It'll then enter a sideways mode. Okay, some will call this a flag, some will call this an accumulation distribution. Okay, the important thing is once you see this, all right, you're looking to be a buyer of absorption. Okay, and then you're then looking to add on to a position to pyramid or to get big in a position through the break and extension. Okay, this is one of those examples again in terms of execution where we will be looking for some form of a nice aggressive execution. Now, what I will say, if we look at some of the other principles to focus on in terms of shading, okay, as we mentioned in the absorption and auctioning, we're going to see dark shades at the extreme, dark shades at the extreme. When we get the break, again, we're likely to see imbalances and low volume and light shades. Okay, what you might see as a difference, okay, not necessarily, but what you're likely to see is when we do extend in a midday initiative drive, it might not be as straightforward. Okay, so you might not see the imbalances, you might not see the directional straight line move. Okay, it might be a little bit more of a, say, one time framing continuation or a little bit more of a grind higher type price action. So again, so important, identify the pre-context in which this initiative drive occurs, know the principle, i.e. when it comes at the beginning, there's a lot more to come behind it. When it comes in the middle of the day, there's a lot more strategies in the market that are providing liquidity. Okay, now, in terms of balanced or imbalanced markets, what I would say is initiative is initiative. Obviously, if it occurs outside of range, we can assume that maybe there's going to be more stop up and more rally, but that isn't always the case. Okay, so the balance or imbalance is relatively irrelevant. What we're more focused on is what time this occurs. Okay. Now, do bear in mind, initiative is created by large time frame participants. Okay, so large time frame. Okay, influential participants. So again, the most important thing, if you know there's large time frame participants entering the market, the last thing you want to do is fade the market. So again, like I say to you in every one of these strategy sessions, it's not necessarily about doing what I say or what the strategy is, but if you observe an initiative drive, just understand that the initiative drive by definition is large participants. Okay, Goldman Sachs with their 25,000 contracts is not price sensitive. So all you're doing by selling and selling and selling is you're providing liquidity to a market that is illiquid. Okay, so factor that in and don't make the mistake. Okay, obviously liquidity is what ultimately drives the initiative. Like I said, at the start of a session, there's probably a lot less liquidity being provided, hence why an open drive tends to overextend and look more aggressive. Okay, whereas later on the session there's more liquidity, and that's why it can still extend, it still continues, but not always as aggressive. Now, note, I did mention the imbalances. You'll tend to see imbalances more on the open drives rather than the imbalance, or rather than the initiative drive that occurs midpoint in the session. And in terms of what it looks like on a candle, again, it's so important to cross-pollinate your trading tools. But in terms of a candle, it's going to look like a really big full-bodied candle. Okay, so if at the open of the session you see a really full-bodied candle, that's the clue. There is initiative in the market. You will see high volume. You will see high volatility. You will see high delta. Okay, now, in terms of the trade strategy, this is quite a simple one to execute, and it's quite a lucrative one. These are fantastic when they occur. We've seen, I'd probably say over the course of 2017, we've probably seen about 15 of these in the E-mini S&Ps. Okay, now, if you know that over the last 15 open drives in the E-mini S&P, every single one of them has been successful. Okay, so with that sort of a statistic in mind, I mean, you can leverage as much as you want, as much as you're willing to leverage. All right, and that's where the whole concept of patience comes in. Okay, patience isn't how long you can wait. Anyone can wait a long time. But patience is what you do whilst you're waiting. Okay, if you're that person that, you sit there and you click away and you just get sucked into the noise and the assumptions and your feelings and your thoughts, well, again, you're not being patient. Okay, the patient trader is the one that observes. There's been 15 open initiative drives this year. On each one of those, you could have, bought anything from 10 contracts up to 2,000 contracts. Okay, you do the math, guys. You take 10 ticks every time. Okay, that's your year made in one trade strategy. Okay, and again, I know that's very simplified, but that's ultimately where I want to get you guys to. I want to move you away from this concept of running the euro dollar for 200-300 ticks. Okay, and get you to more thinking about leveraged trading. Why? Because leveraged trading is ultimately where we have an edge still. Okay, we don't have an edge competing against hedge funds with more information trading swing style. Okay, obviously we can still trade that, but not with highly leveraged positions. Okay, and that's the key. What we still can do is we can trade highly leveraged positions when we have very unique trade strategies. Okay, now in terms of the trade strategy, how it works is very simple. So we acknowledge either the open drive, okay, and I'm going to annotate it with the imbalance, or we have the high volume, okay, which is more of an initiative drive later on in the session, not quite at the cash open. In essence, we're looking for the first pullback. Okay, now this first pullback is going to show us lots of dark deltas at the extreme. Okay, lots of dark deltas. What I would suggest is you can enter on the first pullback. That's a safe way, but just bear in mind, if you do enter on the first pullback, there is a high probability we're going to have a second and even potentially a third and even a fourth pullback. Okay, so you are going to have to sit, but again, it's all about acknowledging risk reward, which is if I enter on the first pullback, I know I'm in for their potential extension. Okay, remember, that extension is not based on a level. That extension is not based on my feelings, my thoughts, how big a level it is. That extension is based on when Goldman Sachs decides that the liquidity is up and they need to extend and go to market again. Okay, again, I hope I'm driving home that the markets are not driven by charts or by anything other than the interaction between buyers and sellers. The footprint will show us that interaction. Okay, now, like I said, the tip is to observe this part. That's the tip. Observe this part. Observe this part. Decide what context it's in. Then execute on the first pullback when you see that absorption and you want to sit long. Again, what I would say, work on your stop. Okay, there's no exact stop here again, but don't be too tight on a stop here. Okay, for me, generally I will use a stop with the same measured amount as this rotation. In other words, if this rotation is 12 ticks, once I enter, I will have probably between an 8 and a 12 tick rotation. Okay. Equally, if we do continue to move lower on one of these second rotations, I won't be afraid to buy more. Okay, so long as this imbalance holds, the trade strategy is still in play. Okay, then obviously, once we do extend, if you do want to leverage, that's the time to be big. Once we get that sort of leveraged position on just before the extension. Now, what I would say, again, as a little tip, as a little nuance, type of piece of price action, what you're going to find is once we get back to this extreme point, you're going to see, so initially at every one of these highs, we're seeing the selling absorption bigger than the buying. So we're seeing a lot of sell side response at these extremes. Now the moment that flips around, the moment we start to see the buyers absorb more than the sellers are selling, and you see absorption from the buyers over here, that's the market readying itself for the extension higher. Okay, that's the key to trading this, and we'll see that in the charts in the next couple of slides. Now, no different on the second initiative drive, waiting for that pullback. The only difference is the extension. Okay, the extension might not be straight drive. It might be a little bit more of a type of grind higher, maybe a one-time framing higher. Okay, let's take a look then at some of the examples that you'll see with regards to the initiative drive. And so the first one, obviously, is a cash open drive. And again, we can see this in the E-mini S&Ps. It was on the 13th of November. I do think this was one of the last ones we actually saw this year, if I'm not mistaken. Now, the important thing to note is we obviously start off with a high amount of volume, high amount of delta. Now again, note, sometimes what is quite tricky about the initiative drive and why it's a patient strategy is that a lot of the time you have to forego this. Okay, obviously, if there are other strategies in play, maybe some of your other strategies that are working well that allow you access to this trade or to this move higher, that's brilliant. Okay, but in terms of the initiative drive, that first part we're not interested in. Okay, what we are interested in is observing it. Relatively high volume, note the delta, cumulative in terms of the direction. Okay, the market then consolidates. Okay, we get our first pullback. Okay, as we can see, we get our first pullback, and once we get that first pullback, we are then looking for long-sided trades. Okay, so that's what an initiative drive will look like from the cash open. Sometimes it's a lot more directional, so sometimes these are obviously 5-minute rotations. Sometimes the first 5-minute rotation might even do that. Okay, you might even get the first 5-minute rotation, a pullback, and then an extension. Okay, the concept's the same, the principle's the same, and the manner of execution is the same. Okay, let's have a look at another example. Now, obviously, there's another example of the initiative drive. So again, we can see the market, has a drive. This is a midday drive now. This is not so much a cash open. This is the oil. Note again, 5-minute rotations. This initiative drive took place in the middle of the day. Okay, so remember what I said, middle of the day. Sometimes you will see the extension, the aggressive extension, sometimes not. Now, again, how we identified, like I said, if you don't have a footprint, you'll obviously see a relatively large pickup in volatility and volume. Okay, look at that sudden shift. 13,000 contracts traded, 1,500 contracts. Market goes, it extends, finds a bit of responsive selling. Okay, backs off. We have the absorption. Note what we said. Once we have that absorption, we're long. Okay, we're looking for a stop in terms of that measured move. Okay, so somewhere around here, and we're looking for an extension and continuation. Now again, obviously, like I said, the two examples I gave you looked a little bit more like this, okay, and spent a lot of time moving sideways. These ones, okay, this was only, say, 15 to 20 minutes, okay, and the previous one spent maybe 15 to 20 minutes as well. So again, those are the little nuances. By practicing this trade strategy, you're going to learn, okay? If it's less time, in this sort of sideways zone, What does that imply? Versus more time, what does that imply? Okay, those are the little things you're going to learn through practicing this time and time again. Now, let's take a look at an example in one of the markets, and what we're going to look at is the E-mini S&P on the 15th of December. And in actual fact, I think that this wasn't a cash open drive. This was also middle of the session. So let's have a look at this and see how this plays out. Now, again, in terms of context, this is going to start right at the beginning. I'm just going to actually show you the initiative first. You can go watch this entire video back yourself. But the first thing to point out, note the initiative. Okay, so we get the open. In fact, sorry, apologies. This is a cash open drive as well. This was taken on the 15th of December, so this was the last cash open drive. We could see straight away as the cash opens, 18,000 contracts. The market moves almost 4 handles, very directional. Note the imbalance. Okay, so that's always a very early clue. If you get a cash open drive or initiative on the cash open, you're likely to always see those imbalances. Okay, now, as you said, I'm going to fast forward this to the point where the market enters a sideways balancing. So again, this is the key thing. You got to remember, sometimes the markets will take time to move sideways. Sometimes they could move sideways straight away. Okay, in the first example, we saw the market rotated higher and higher for a good half an hour. In this example, note obviously we had the 5-minute drive, and then we've already seen liquidity being provided. So note, once the liquidity is being provided, we're looking simply for the absorption. There it is, 2,300 contracts. We're then looking for a buy-side trade. Okay, so we're now long the market. And remember what I said, this can take time to extend. Okay, it's so important and crucial that you understand that the market can take time to extend. So you do have to be very, very patient. And most importantly, respect where your stop is. Okay, respect the trade principle, respect the trade strategy, and ultimately, once the responsive sellers are done providing their liquidity, you'll ultimately see the market then go bid and continue higher. Okay, now just a few little observations. Note, obviously, this is an imbalance chart, so you're not going to quite see it here. But notice the absorption on the bid, absorption on the bid, absorption on the bid. Also note the delta. Okay, so the first time we sold off, good negative delta. Again, we spoke about this in the in the strategy on highs and lows. So that's a really good example of two strategies combining, a little bit of an exhaustive top. Again, that does not imply that it's the top of the market. It just simply implies the market's taking a breather. Another one of the principles we obviously identified, note the 1500 lot traded at the high. That is a bad high. So again, if we are in the frame of mind that this is an initiative drive, we know the probability of extension is extremely high. Why? Because we have a number of strategies in play here. One, the initiative. One, the auction imbalances. Another one, the absorption of the low as well as the bad high. So it's a real confluence play. Now the last thing I want to show you is what occurs just before the extension. This is the real key to getting good at these, to timing them. Like I said, note, that's almost a good 30-35 minutes now. You've had to sit in this trade, but you felt no real heat. We entered around that 3,000 lot, and we felt relatively little heat. Now, remember what I said, the key tip, patience, obviously, in identifying the strategy, but then also patience once you've executed. Now, note, what we're looking for is we're looking for this sort of absorption coming from the buyers. Why? Every time we've seen sellers responding to these higher prices, the moment the buyers start to respond to the higher prices, that's usually a signal that we're about to see a continuation and extension. Again, notice the buying absorption there, quite aggressive. And let's see what happens once the market extends. So again, look at that, quite a lot of aggressive buying absorption at higher prices. Again, another bout of aggressive buying absorption at the higher prices, and ultimately we then get the continuation and extension. Okay, note in terms of the continuation extension, this is an open drive, so the extension is usually quite aggressive. Again, note the imbalance, quite a strong imbalance, and the market extends again until it finds liquidity. Okay, just remember, an initiative drive is nothing more than someone's taking initiative. They need to get an order filled. Therefore, they'll keep at that order, and they'll keep persisting to getting that order filled until they get enough liquidity. Okay, so again, just make sure if you don't really like the strategy, just make sure you don't go against the strategy. Okay, now let's look at one more example of the initiative drive. This came in the pound against the dollar. Again, this was a midday type strategy, so it wasn't quite at the cash open. And again, I'm just going to show you the initiative first up. So we can see obviously nice little imbalance down below. Okay, really important imbalance. Quite a lot of absorption taking place in front of the imbalance. So again, we could see the imbalance strategy holding quite nicely. And again, like I said to you, sometimes, this initiative trade, you might not always get, you might have to sit on the side and just watch the initiative. But if you do get these sorts of imbalances, like I showed you in the imbalance strategy session, don't be afraid to jump on and get on with the trend. Okay, so we can see now the market continues the process of moving higher and higher. I'm just going to keep fast forwarding this. Do note obviously the delta on the day, the cumulative delta on the day, 2000. Also notice the relative volume quite high. These are also 5-minute rotations. So note we are forming a process of one time framing, i.e. this candle, the next candle fails to take out the previous candle's low, and so forth and so forth. Okay, let's look now. Let's play this initiative out so we can see what that first pullback looks like. Again, remember, the market will continue to go until it finds the liquidity or the response of selling, and then it'll back off. Now, notice the imbalance at the high. Like I said to you, market that's exhausting itself will begin the process of showing imbalances at the high. Now, note, this does look like a very potential opportunity for an exhaustive high. Why? Notice what we're seeing now. Okay, we're starting to see divergence here. So we're starting to see the process of more selling at the extreme versus buying, i.e. delta divergence. Okay, so the market does back off. We've seen an exhaustive high now. The market does back off, and we start to see the process of moving sideways. And the market moves sideways and sideways, fills out the imbalance. Okay, at this point now, we know the initiative's in. We're looking for our absorption and first pullback point. Now again, a lot of people are going to say, well, where is the first pullback point? Okay, how far is the pullback point? Again, I don't want to give you an exact answer. Okay, this is going to come through practicing this trade strategy, observing it. But what I do like to do is I do like to potentially either use maybe a Fibonacci retracement and get to somewhere around the 38.2%, or pay attention to where that absorption steps in. Okay, that for me is the most important. When the market pulls back, that point where the absorption takes place, that's the real reference point I'm interested in. Now again, notice how this example, it pulled back to that last real bout of, sort of buying absorption we saw, and very quickly navigated higher. So a really, really tricky one to get onto. We can see obviously the market just kept rotating higher and higher in a manner of one time framing. Now, the reason I want to show you this example is because a lot of the time, we may, I'm just going to reverse this a little bit, we may look at this first rotation and think that is the rotation, that is the beginning process of a pullback. Now what I will say as a rule of thumb in an initiative drive, the pullback should be at least a couple of minutes or rotations. Why? Because by the definition, when there's initiation, the market is trying to find some sort of responsive liquidity. Okay, so if someone is responding to higher prices, i.e. a seller, we should see it continue for some time, okay, not just one rotation. All right, and that's the real clue. Obviously, this did continue to extend in a one-time framing manner, and ultimately, eventually, it did pull back and give us the opportunity to enter long. Okay, that's then the initiative drive. Obviously now go and practice that in the slides ahead. We're going to go through that template together, and then make sure you practice, because that's what's going to develop your real edges.
So you should have a really good understanding now of the initiative drive and why it's such a an important strategy to adopt into your arsenal. Now, obviously, we're going to complete the template again, and we're going to begin with our observation. Now, context is crucial. You will understand that now, obviously. So the most important thing is to obviously define what time of the session that strategy has occurred, or that initiative has occurred. So obviously we do want to see these within trending conditions. You won't see it in consolidatory conditions. In terms of balance, it will generally start from imbalanced or imbalanced. Okay, so it can come from either type of conditioning. However, imbalanced will bring slightly different volatility. Okay, so the way the market will move, the type of volatility, the way the auction process takes place, the interaction between the buyers and sellers will be very, very different whether we're in balanced conditions or imbalanced. And that's, again, the importance of this template. You're going to be very quick to identify, when the market's balanced, it does this and that, but when it's imbalanced, it does this and that. And that's the key behind ultimately this strategy. Now, obviously in terms of trade location, this can begin mid-range, but also at extremes. And then in terms of market conditioning, in terms of the participants, note initiative means large time frame participants. Okay, rule of thumb, whenever we speak about initiative, it means we require large time frame participants to ultimately drive the price. Okay, so they begin the process of initiation and move prices. Now, obviously, you do get other participants joining as price begins the process of exploration. In terms of liquidity, if we do see this, at the open, we do tend to have low liquidity. Okay, not many strategies in the market, and we said what the result of this would be is likely some form of imbalances or a very volatile start to the session. Okay, so look quite aggressive if we see this at the beginning of a session, versus later on we can have higher liquidity as there's more strategies in the market and ultimately more liquidity available. In terms of volatility, higher with the open drive versus mid-session, simply because of that lack of liquidity, and overall price expansion with both variation. So it doesn't matter what time of day it comes in, you're going to get some very aggressive volatility as the nature of initiative drive does include trend, which ultimately means some form of volatility. Okay, let's now turn our attention then to the strategy identification. So interaction is really, really crucial. Yeah, spend a lot of time, really looking at those delta bars. Look where the absorption's taking place. Look where the buyers are being aggressive. Look where the sellers are being aggressive. Really look at those delta shadings so that you can understand this interaction in the strategy. Now, note, we will always see initiative until we run into responsive. Responsive simply means, delta pocket positioning or high volume areas, and we will initiate until the market can find that ultimate liquidity. Do note, obviously, this is a very aggressive type of interaction. You'll see even once we do find that liquidity, we do tend to see quite an aggressive interaction between both the buyers and the sellers. Now, in terms of the metrics, volume will always be high in initiative drive. Why? Because initiative means new business. Okay, as new business comes in and drives price higher, it brings in more participants, which means even more business. Okay, in terms of time, it's a very key proponent. Like I mentioned earlier, cash open, we're going to see a different initiative drive to potentially mid-range initiative or mid-session initiative drives. In terms of the delta, it should consistently build with obviously the initiative. We want to see it build in the direction of the initiative as well, and also the cumulative delta should accumulate in the direction in which initiative is being taken. In terms of the relative changes, high at the beginning of the initiative, and then consistent, whilst it's initiating. Once we obviously then run into that responsive, we will see quite a significant relative change. And again, you're going to notice a lot of nuances on this initiative drive, so make sure you're picking up on these relative changes and how they can ultimately aid you in your decision making. Okay, let's now go and have a look at then the execution section of the template.
So execution is relatively straightforward for the initiative drive. Ultimately, it's quite a passive entry, and we can be quite aggressive on this. The wonderful thing about initiative drive is that we know there's a high probability for not just a retest of the extreme, but also an extension. Now note, risk is very simple. Once we find that absorption, that first bit of absorption, we ultimately place our stop in and below that. Now, bear in mind, you will know more or less a potential target. You'll have an idea for a potential target. So don't be afraid to have a slightly wider stop when there is that initiative. Like I said, there's a high probability for extension if it occurs early in the session versus later. But in both instances, you've got a really good target. So don't be afraid to adopt a slightly wider risk metric. In terms of targets, retest of extreme and continuation depending on the context of the drive. And this is crucial. This is why we said one of the key principles with this was context, okay? Depending on where the initiative drive is placed in terms of the big picture of the market, that'll ultimately depend on how much more legs it has or how much more of a target or a bigger target you can potentially take. So do make sure you're really focusing on context, especially in the first part of this template. Make sure you're working on that and really trying to find the link between obviously market context and the potential rewards you can take. Okay, ultimately through completing this template, you are going to be beginning to recognize, which context you can take bigger winners versus which context you need to take slightly smaller winners. Risk reward will be one of the highest because you've got a really, really tight stop. In terms of application, you can afford to be a little bit preemptive here. Again, why, like I mentioned in one of the earlier units, you can always preempt if you've got very good reward. Okay, it's okay to preempt if you've got really good reward because you don't want to potentially miss out on that very big piece of cheese. Okay, so keep that in the back of your mind. Do just bear in mind when you are preempting, you're taking on a slightly more risk, so do just factor that in. In terms of leveraging, yes, 100% we leverage, but only if we get the absorption just before the break. Okay, my tip, don't rush in. The market will reward early observation and patient execution. And that's one of the key tips for the initiative drive. Don't rush in. Let everyone else rush in, panic in, just really, flush of blood to the head. Let them panic in whilst you keep your head. You work out your exact metrics and you simply execute once the market gives you your passive entry point. Okay, let's now go and wrap up Unit 11. So this was actually a book that was recommended to me probably about 5-6 years ago. Anna Cooling, probably well known in the trading circles. She's one of the few, or this is one of the only books that will have some real market technical terms. But not to worry, it's all about volume, price, analysis. So it's just about volume and price and the divergences between volume and price and the concept of anomaly. So I really want you to just read through this book, learn these principles. Don't learn hard, fast rules. Avoid the hard, fast rules because, again, hard, fast rules are not important. What's important is understanding principles. Okay? See what you can get out of this book. It's a really, really good book. Note, obviously, a summary. It's a modern-day view of an approach to viewing the market. So you'll note she takes a very structured approach to the markets. And that's similar to what you found in this course. In terms of action, you're going to want to adopt a very simplified rule-based approach, and again that's something we've tried to implement here, where we're not preempting the market. We're not trying to be too subjective and opinionated. Rather, we have an understanding of various strategies. When the market shows the information, we merely execute one of the 10 strategies based on the fact-based information. Key highlights: volume traded has become a key proponent in financial markets in recent years. Okay, this was obviously written at a time when volume was becoming more and more focused on. Obviously now everyone focuses on volume, but back then when she wrote it, it was still a relatively new concept. Ultimately, why volume and price response is so important and relevant. How to create and adopt a rules-based approach. I really like that section. And ultimately, a simple yet effective approach to understanding underlying principle behind volume, and that's the real crux of it. You really want to understand what volume signifies in your market. What it means in terms of observation, what it means in terms of interaction. Don't forget, this footprint tool course is all about interaction, and volume shows us that very interaction. Let's now move on to the drill section and wrap up the unit. So you know the drill. You simply want to watch the drill, complete your own template, then watch the drill with the guided tuition, make some notes, adjust, move on to some of the videos we did within the unit, view those again, complete the template as best you can. And when you're confident, you then consider moving on to the next unit. Obviously you do have a day off tomorrow, so again, you know, if you need to catch up, if you want to revisit some of the slides, don't be afraid to do that. This is time for you to catch up and really ensure you understand the trade strategy. To finish, patience is not how long you can wait, but it's what you do whilst waiting. And this is fantastically big, because you know, most people seem to think, oh, I'm patient, I don't mind waiting, okay, but not many people can keep a still mind, a still thought, you know, inactive whilst being patient. And that's the real art to being patient, okay? It's how you behave whilst being patient that ultimately dictates whether or not you have actually adopted a skill of patience or not. Thank you, and I'll see you guys again in Unit 12.